Our clientele consists of companies across New York State and the United States, especially when it comes to architectural and engineering firms. And we represent a diversity of business enterprises. We have offices with headquarters in Syracuse and additional offices in Binghamton, Schenectady, Auburn, and a satellite office in Tampa. We provide assurance, accounting, tax, forensic, valuation, and advisory services. And in addition to the AE industry, we also serve clients in the automotive, construction, healthcare, manufacturing, not-for-profit, and retail wholesale space. We also have a sister firm, DM Consulting Group, which was previously known as Dannible McKee and Associates. We recently rebranded to DM Consulting Group, and we have over 40 years of experience working with AE firms to help them determine the fair market value of their firm, establish buy-sell agreements, and develop ownership transition plans. As I said, DM Consulting Group does business valuation, whether that's for internal ownership transition planning, mergers and acquisitions, estate and gift tax, ESOPs, and a variety of other purposes. For the ownership transition planning, sometimes that's internal plans that we assist with developing. We also assist with stock redemptions, non-statutory deferred compensation plans, ESOPs, recapitalizations, mergers and acquisitions, and buy-sell agreements. We also do a variety of consulting services, including benchmarking your firm, looking at ratios and some financial analysis. We help develop incentive compensation plans, which are often critical to internal ownership transition plans and the funding. We do FAR overhead rate analysis, as well as litigation support and employee benefit plans. I'm Deb Finch. I'm a CPA. I'm also accredited in business valuation through the AICPA, and I'm a certified valuation analyst through NACFA. In addition to being a semi-retired partner at Dannible McKee, I'm also a principal with DM Consulting Group. Can skip through that. So the starting point in looking at what a firm might be worth is to make sure that we're on the proper accounting basis and that your financial statements are in the correct format. There are two methods of accounting. One is the cash method, and that is a method where income is recognized as the cash is received. Expenses are recognized when the cash is paid. So much like your checkbook, it's keeping track of your cash. And that's when the ins and outs generate the income and expenses on your income statement. The advantages, it's popular because of its simplicity. And most small businesses are allowed to use the cash basis method for tax reporting purposes. Even though I'm no longer working in my tax partner role, I will put a little plug in that if your AE firm is not on the cash basis, please give me a call and I'll hook you up with one of my tax partners, because you most certainly should be on the cash basis for tax purposes, so that you're not paying tax on receivables prior to the cash being received. The disadvantages of the cash method: it's not in accordance with GAAP, which is generally accepted accounting principles. And that may or may not matter if your firm has reviewed or audited financial statements. Presumably, they're putting you on the accrual method, which is in accordance with GAAP. The cash method also understates both net income in a growing firm as well as net worth on the balance sheet, because you're always behind the growth that's happening in your accounts receivable on the income statement, and your accounts receivable and unbilled work in process are not reflected on the balance sheet. For the accrual method of accounting, income is recognized when revenue is earned, and expenses are recognized when they're incurred. So the advantage, and it's very important, and both for valuation as well as for managing your firm, is that the accrual method properly matches the revenue and the expenses. So as you're generating revenue, the costs, whether that be labor or direct expenses or outside consultants, those are being recognized even though you haven't paid those subs and other invoices yet. It does comply with GAAP. It's not as simple as the cash method. So I guess that's the one disadvantage. Looking at a sample balance sheet on the accrual basis, you can always pick up a balance sheet and tell whether it's labeled or not, whether or not it's on the accrual or the cash basis. And that's because the accrual basis balance sheet, as I mentioned, is going to reflect some of your largest assets in a design firm, your accounts receivable, your unbilled work in process. It also picks up prepaid expenses. So rather than expensing 100% of, let's say, an insurance premium that you pay for the whole year, rather than that getting recognized as expense in a single month and a single period, that becomes an asset on the balance sheet and is recognized or expensed on the income statement over the time period that it covers. On the liability side, your accounts payable, client retainers, other accrued liabilities such as accrued payroll and vacation, those things would be reflected as well. And deferred income taxes. Now, you would only see deferred income taxes if you're a C Corp on an accrual basis balance sheet. However, one of the adjustments that we'll talk about for valuation purposes is that even for a pass-through entity, we are going to calculate the deferred tax and we are going to tax affect your earnings. The reason for that is twofold. One is when we talk about the multiplier that we're going to use when we get to valuing the firm, the multiplier that gets applied to your earnings is based on information from the public markets. And theoretically anyway, the larger publicly traded companies pay taxes. So that's one reason. But the bigger reason is that if you had, let's say, $1 million in accounts receivable on your balance sheet, and from your perspective, let's say you have a 40% tax rate, that $1 million in receivables, once you collect it and pay the taxes, is worth $600,000 to you. If someone were buying into your firm, they wouldn't want to pay you $1 million for the accounts receivable and pay $400,000 to collect $600,000 at the end of the day. So what we need to do is take those receivables, tax affect them, and now it's worth the $600,000 on the other side of the transaction to the buyer. For the income statement, if an income statement or profit and loss statement isn't labeled, whether it's accrual or cash basis, you won't be able to tell just picking it up. Not even an accountant can tell that just picking it up without looking into the details a little further. What's more important here is the format of the financial statements. So a lot of times we will see income statements that make it appear that you could be a manufacturing entity. It'll show sales, less cost of goods sold. And it's really not formatted in the proper way, so that ideally what you want to be able to do is look at your financial statements and be able to pull out some key metrics from them. So the correct statement format would be to show your gross revenue and then back out your outside consultants and reimbursables. That gives you your net revenue, which is the revenue that you're actually generating from the services you perform. From that, we want to subtract direct labor, and that's going to give us what's called a contribution margin or gross profit. That's one of the first ratios that we want to see. The industry standard, and these industry standards throughout the day, unless I say otherwise, are from PSMJ. And in all cases, they're based on the overall industry. We haven't, or rather we can drill down based on the size of the firm, based on what type of firm you are, based on your client mix. Are you government or private or a mix of both? So PSMJ offers all of those different ratios for any given metric. But the industry overall is about 70% for gross profit. And I would say that has remained fairly consistent, 68, 72, right around there, somewhere around 70%. Now, the next category is your indirect or overhead expenses. This has obviously been truncated so that you can actually read what's on the screen, but this would include your indirect labor, rent, insurances, office supplies, all of those overhead expenses would be included here. And that's going to give you your operating income, which represents the net income generated from your normal operations without discretionary items. The next item, and just as a caveat, the industry is at about 20% now for as a percentage of your net revenue. That's what all of these are hinging off of. Then we get into other income and expense. You could have interest income, interest expense, miscellaneous income, gains and losses on the sale of fixed assets. You may have had some PPP loan forgiveness in there in the past. Employee retention credits may have landed there. Some firms have significant investment income if they're carrying investments on their balance sheet. So those items would be there. This gives us a really key number for the firm, and that's the net income before discretionary items. It's also before taxes. The industry, as of last year, is at 19% as a percentage of net revenue. And these are really the dollars that are available to the owners before taxes and before making decisions about discretionary expenses. So it's a key dollar amount when we look to valuing the firm, because this is really what someone is going to buy into and have the right and ability to share in. For discretionary expenses, there's a little caveat here. To some extent, neither bonuses nor profit sharing contributions are entirely discretionary. Obviously, there's the annual bonus that you may pay 1 or 2 times a year, as the case may be. And if you were to stop paying those, you would have a very difficult time retaining employees. So that's really not discretionary. But when the firm has a banner year and you pump a little extra into the discretionary bonuses, that's what would be included there. It's important to note that they all get reported there below the pre-discretionary income line. It doesn't get included in your indirect labor up above. And that's important when comparing yourself to the ratios from PSMJ. Same goes for profit sharing contribution. You may have let's say a 3% match that you have to make every year, a safe harbor. But there could be a profit sharing piece to that is discretionary. And again, sometimes when you have a really great year, rather than paying it all out as cash bonuses, you may put a little extra into the employee's profit sharing. That gives you your net income before taxes. The industry's at about 12%. And then you have the income tax expense, which brings you down to your net income after tax, which should be, according to the industry overall, about 9% of your net revenue. So now that we know how the financial statements should be formatted and that they should be on the accrual basis, we'll get into the methods for valuing a design firm. Any valuation, but certainly AE firm valuation, is both an art and a science. And the science represents all of the valuation theory, the systematic approaches, the quantitative analysis, all the number crunching, research about the subject company and the industry in which they operate, and any other internal or external factors that might impact a firm and its value. The art is represented by those who have the depth of experience and expertise in the science of valuation to reach a good conclusion about value. And I would say here to be careful when you look to someone to do a valuation. It's important to go with someone who really understands your industry, and it's not just one of many. Let's say that they'll do a valuation for any type of industry and for any purpose. Here at our firm, as you can see, we really specialize in AE firm valuation, and that's important because we understand how the industry operates. We can get a really good gut feel from a lot of the ratio analysis that we do. And it makes the whole process both seamless from your perspective, but also I would argue that we come to a value that is supportable. I already mentioned that there's lots of reasons for AE firm valuation, so I won't go through the whole list. Internal ownership transition has historically been an important one, and we're continuing to do that. Mergers and acquisitions have ticked up to a significant degree. I'm working on one right now, and it's one of several I've worked on this year. We also get into it for estate and gift tax purposes. Just as a quick note, you can't gift stock in your company to an employee unless they're related to you. There are mechanisms that you can use, and I'd be happy to discuss that with you offline, which brings me to a good point. The program is being recorded. Everyone can have access, or will be sent a link to the recording. You'll also get copies of the slides. And we are not doing no CE credit for this today. But there's obviously a lot of reasons. We do some valuations for ESOP plans. Those are some of the big ones. You know, certainly divorce comes up, and certainly shareholder dispute type cases can come up. My hope is that if you find today's webinar helpful, maybe you'll attend one of our half-day seminars on valuation, and we also have a half-day seminar on ownership transition, where we discuss some of the critical elements that should be included in a buy-sell agreement. And hopefully, by thinking of all those things ahead of time, you can avoid some of those shareholder disputes. So standards of value. The standard of value is basically the set of assumptions regarding the specific characteristics of the buyer and seller to the transaction being contemplated, which basically means we're either dealing with an actual or known buyer or a hypothetical buyer. There are three principal standards of value for valuing a closely held business. One is fair market value. The next is fair value, which is defined by statute. So I don't think I go into all of these in great detail here on my slides today. We're going to stick mostly with fair market value. And then investment value is really that strategic value that would come into play more for mergers and acquisitions. IRS Revenue Ruling 5960, which was enacted for estate and gift tax purposes, nonetheless has sort of become the Bible, if you will, for defining fair market value, and valuation professionals look to it both to define fair market value, and as you'll see, there are some considerations that we need to take into account when we're preparing a valuation. But fair market value is the price at which property would change hands between a willing buyer and a willing seller, where the former is not under any compulsion to buy and the latter is not under any compulsion to sell. Both parties have reasonable knowledge of all of the relevant facts. So again, it's a hypothetical buyer and seller, and they're assumed to be able as well as willing to trade and be well informed about the property. So fair market value comes into play in tax situations, as I mentioned. So estate and gift tax, purchase price allocations, those are the situations where you would see fair market value utilized. Again, calling out the key elements are that it's a hypothetical buyer and the transaction is at arm's length. Premiums and discounts are generally considered. So if it's a controlling interest, there may be a premium for control. If it's a minority interest, there may be a discount for minority interest. And it's not unique. So again, it's based on a hypothetical buyer and seller. So that value could be affected when actual buyer and seller come to the table, depending on what is motivating them in the transaction. Fair value, again, is defined by statute. So it's the appropriate standard of value for dissenting rights cases, shareholder oppression cases. It doesn't say it here, but divorce cases. Fair value is generally equal to fair market value, but without a discount for minority interest, because we don't want to harm the oppressed shareholder and discount their value. They just get their pro rata share. And then depending on the state or the court that you're dealing with, a discount for lack of marketability may or may not be appropriate. Investment value, also called synergistic value or strategic value. This identifies a particular buyer or seller and the attributes that bring them to the transaction, what's motivating them. So it would pick up on the synergies that will come into play. It will pick up on, let's say there's an acquisition happening in order to kind of block the competition, or to acquire employees, or to acquire a client list. All of those specific attributes are considered. And therefore, it's usually the standard of value that's utilized in mergers and acquisitions. There are also levels of value, and they speak to characteristics of marketability and control. Now, those can be applied by utilizing discounts and premiums to get the discount for a lack of marketability, to have a control premium or a minority interest discount. But alternatively, you can adjust the discount or capitalization rate, which we'll talk about in a little bit under the income approach, and build those in to those discount or cap rates, and therefore into the multipliers that are being used. This just illustrates kind of how the values line up. The top highest value is going to be your investment value, synergistic value. And the next is going to be fair value. And here again, there's no premium for control, no discount for minority interest, and it's a maybe on the discount for lack of marketability, depending on the state. And then the lower value is fair market value, which is for income, estate, and gift tax purposes. Here you would apply a premium for control or a discount for minority interest, and you would apply a marketability discount. Premise of value is an assumption regarding the most likely set of transactional circumstances that the subject company is going to be in. And the three main premises of value are going concern value. And that just basically means that the business is expected to continue to operate into the future, essentially the same way it has in the past. It's going to have that trained workforce in place. It's going to have all of its infrastructure, licenses, policies and procedures. All of those things will remain intact. And that's the most common premise of value that we see. Next, you have orderly liquidation value. And that's the value at which your assets would be sold over a reasonable period of time so that you can get the best price for those assets. And then you would satisfy any of the debt of the company. Forced liquidation is what we hope to avoid. That's the fire sale. And that's liquidation where you're trying to just sell your assets as quickly as possible, to recognize the sales proceeds quickly. And then you would relieve the debt associated with those assets. So the difference there is just the time you take to get the best price. Now, I mentioned that revenue ruling 5960 is utilized to a great extent by business valuation professionals. And there are 8 factors that need to be considered when we're valuing a firm. The first is the nature of the business and the history of the enterprise. So just understanding the entity itself. The second is the economic outlook in general, and then the condition and outlook for the specific industry in which the entity operates. The book value of the stock, that essentially is referring to the equity. And just quickly, the equity in the firm is the assets less the liabilities. So the example is going to be your home. The home is the asset, the mortgage is the liability, and the equity is the difference. It's the same on your balance sheet. Dividend paying capacity of the business, whether or not the entity has any goodwill or intangible value, sales of the stock that may have happened recently in the past, as well as the size of the block of stock to be valued, again, because that could play into whether or not this is a minority interest or a controlling interest. And then the market prices of stocks engaged in the same or similar line of business where their stock is actively traded on the open market. So those are the 8 factors that we need to consider when we're valuing a business. And some of those will have greater emphasis than others. One that stands out to me is dividend paying capacity. A lot of entities, unless you're a C corporation, you're not actually paying dividends. I know that some of my pass-through entity clients refer to their shareholder distributions or their partner draws as dividends, but they're not exactly dividends. Nevertheless, the ability to make those shareholder distributions is something that we would look at if you've been historically able to pay out nice shareholder distributions or partner draws over the history of the firm. That is something that we would consider. So valuation approaches. There are generally 3 approaches. One is the asset approach, and here the value of the business is based solely on the entity's assets net of the liabilities, including both tangible and intangible assets. Income approach. This is the most widely used method for valuing a closely held business. It's the sum of the present values of the expected future economic benefits attributable to that ownership interest. So we'll talk more about that in a few slides here. And then under the market approach, the value of a closely held business is determined by referencing the multiples that are observed for publicly traded companies or for private comparable entities. We can derive multiples of earnings, of EBITDA, and apply those to your firm's metrics. So with the asset approach, that really could be just your book value approach or the adjusted book value method. Now, book value is just looking at your historic balance sheet, which again is your assets minus your liabilities. It's looking to the equity portion of your balance sheet, and that's the value at which the firm is traded. I have, in my 21 years of doing this, I have one firm that trades on historic book value with an adjustment for deferred taxes. And I would argue that that's not really the true value of the firm, and we'll see why in a minute. However, there are benefits to doing that, one of which is the fact that it keeps the price more affordable for employees to be able to buy into the firm. The next method is the adjusted book value method, and here we take the historic book value and we analyze the balance sheet in detail, all of the assets and all of the liabilities, and we adjust those that may need adjustment to bring them to fair market value. Again, it represents the value of all tangible and intangible assets and liabilities, and it's generally considered liquidation value, so it's kind of the floor value of a firm. In other words, this is what the current owners of the firm could sell their assets for, relieve the debt, and walk away with. So that's the bare minimum that a firm is worth. Under this adjusted book value method, I mentioned that we make adjustments to bring your assets and liabilities closer to their fair market value. And here are just some of the common adjustments. One would be securities and investments. So if your firm is carrying investments on its balance sheet, we want to make sure that we mark to market. In other words, if you bought into your investments for $500,000 and the value now at 12/31 was $600,000, we want to make that adjustment, even though in some instances you may not recognize that on your financial statements. Now, if you are having your financial statements reviewed or audited and they're being prepared in accordance with GAAP, they would recognize that increase on the balance sheet and they would pick up the investment income in other earnings. Your billed receivables and an allowance for uncollectible accounts receivable, very common adjustment. Here we look to the history of the firm in terms of bad debt expense to your accounts receivable balance over the last 5-year period. We'll talk about the 5-year period in a little bit. And what we would do is look to see, do you already have an allowance on your balance sheet? If you do not, is it adequate to account for that historic average bad debt expense? And if it's not, we would make that adjustment. We would also look at your AR aging report and look to see if there are some known potentially uncollectible accounts and maybe add that into the allowance for doubtful accounts receivable as well. The reason for that is that if I'm buying into the firm and the firm has $1 million worth of receivables on the balance sheet, and I'm going to pay whatever percentage of the firm I'm buying in, I'm getting that percentage of the accounts receivable. I want to make sure that that's ultimately going to convert to cash. So that's the reason for making that adjustment. Unbilled work in process. Many of my firms either don't, well, I shouldn't say many, but it's quite common to find firms that either don't track their unbilled work in process, or they track it separately and it's not flowing through their financial statements. To the extent that that's true, we would want to look to bring that asset onto the balance sheet, because it essentially just represents receivables that have yet to be billed. An invoice hasn't been created, but the labor cost has gone in. Property, plant, and equipment. This is a common valuation adjustment as well. There's a couple of things to note here. One is we don't go in and do an appraisal of property, plant, and equipment. But there are some cases where maybe you have a handful of vehicles on the balance sheet. We could do Kelley Blue Book, and we've done that for some of our clients to bring those to their current fair market value. But the more common adjustment is where the firm is recording depreciation expense on the tax basis. So let's say you went out and bought $100,000 worth of equipment in December, and then you took Section 179, because that's a good thing to do, and you wrote that $100,000 off immediately. So your balance sheet currently reflects that brand new equipment is worth nothing. What we need to do is add back that $100,000 of depreciation and then spread the depreciation out straight line, which is how it would be done if you were recording depreciation under the GAAP methods and lives. And that way it more closely reflects the current value. So in year one, you would still show 80% of the value on 5-year property, for example. Real estate. Number one, if you don't have real estate in your entity, don't ever put it in your entity. Number two, if you do, there's a couple of ways to go about how we value that. One is to get an appraisal, and another one is for the firm to the management just kind of agree on what they estimate the fair market value to be. And as long as everyone agrees each year, generally there's a certificate of value that gets signed by the owners each year, we can utilize that. The third is just to use the book value of what is still on the books. So those are some of the adjustments. In addition, libraries, maps, and drawings. We used to have a full room that was a library, and maybe your firm is a little bit like that, although a lot of my engineering firms still have a lot of code books and such. But it really is your technical resource library. So think of it as the systems you have in place, the templates that permit you to take on another similar project without having to reinvent the wheel. The example I always use, just because I understand it, is the valuation spreadsheets that I use. I don't have to rebuild those spreadsheets and exhibits every time I do a valuation. I can just take the standard that we've developed and modify it. So it's basically the cost to recreate those items. I would say that depending on the size of the firm, I've seen anywhere from 5,000 to maybe, I have one firm that's very large, it's 100,000, but I would say 5,000 to 50,000 is the normal range. The value of joint ventures. Often when you enter into a joint venture and you put cash into it, it comes on to your balance sheet as an asset. Sometimes those joint ventures really never go anywhere. So perhaps it should be marked down to 0 for its value. In other instances, the joint venture is really up and running, and we may need to value that joint venture to get the value correct on your balance sheet. Cash surrender value of life insurance, very much like investments, we would want to bring that to its current fair market value. And then we want to pick up on unrecorded liabilities such as unpaid PTO, vacation, sick pay, deferred compensation. If that is in place but hasn't been put on the balance sheet, we would need to do that. And then again, deferred income taxes, we would calculate that based on your accrual basis accounts. And we generally utilize, if it's a C corporation, it's probably already on your balance sheet. If not, we would certainly use the 21% federal rate plus the state rate. For pass-through entities, the proper rate is generally the highest rate that's applicable to any shareholder or partner in the firm. So the individual rates. Pros and cons of the asset approach, it's easy to calculate and understand. It does provide that baseline or floor value. However, it ignores the future earning capacity of the business. You're not liquidating, you're not shutting the door and walking away. The business has all of the infrastructure, the employees, the reputation, the client list, all of those things are there. And that to a large extent is missing when we do a strict asset approach. As an example, I have two firms that both have the same book value on the balance sheet, but they have different after-tax earnings. The question, are they both worth the same? Arguably not. That brings us to the income approach. And this approach is most reflective of the forward-looking premise of business valuation. So think about it when you buy a stock in the stock market, you're buying shares of Apple. Are you buying that based on the history of Apple? Absolutely. I mean, that comes into play in terms of the health of the investment, the risk of the investment. But really what you're paying for is what you think that investment will do in the future in terms of both growth and value, and then any dividends it would pay. So forward-looking premise is important in business valuation. And again, under the income approach, the value of a closely held business is equal to the present value of the expected future economic benefits discounted at the appropriate rate to reflect the risk associated with the entity. I know that's a lot, but basically it's a formula which would be the expected future economic benefit stream divided by the discount rate. And we'll talk about each piece because those are the two important components. So first, the economic benefit stream should match the characteristics of the denominator, that discount rate. So if you're using an after-tax discount rate, you need to be using after-tax earnings or cash flow. And then with that being said, generally, we utilize an after-tax net income number as the benefit stream amount. In order to predict future earnings, the firm's past earnings may be used as a guide. That's important because a lot of firms, some firms will have a budget for the next year. Most don't organically have projections for, say, the next 5 years. So it's often much easier and much more supportable to use history and use the historic earnings. This just walks through the overall income approach process. The first is normalization. So we make adjustments to eliminate tax bias, to eliminate discretionary items, non-recurring items, those types of things, non-operating items from the earnings stream. So the 1 year that you have an E&O claim and have to pay a $50,000 deductible, that's the type of item that we would want to normalize and add back to your earnings stream. Defining the benefit stream, is it going to be cash flow or earnings? And is it going to be before or after tax? We then develop a discount rate, and I'll talk about that briefly in a second. And then we calculate the present value. So the benefit stream, again, we're going to adjust for abnormal or extraordinary items like the example I just gave, non-operating or non-recurring items. An example could be rental income, maybe you're subleasing. That's not really part of operations. However, if it's always been there in your earnings stream, one would argue that it is in fact part of the earnings stream that should get valued if a future owner is going to share in that. Non-recurring items, think COVID, PPP loan forgiveness, employee retention credits. There we had to look and see, was it a windfall or not, and make that decision. Maybe you started a new office and all of that expense, or moving to a new office, setting up a new one. Some of those non-recurring expenses we would want to normalize in your earnings stream. So here's a list of some of the more common adjustments. Discretionary bonuses and salaries. So for the owners and officers of a firm, we would look to PSMJ for what the industry standard total compensation is and adjust the owner's salaries accordingly, because that may or may not be commensurate with what it takes to actually run the business. Some of that really is just profit sharing. And you want that added back into your earnings stream, because if I'm a buyer, I'm going to share in that now, so I should pay for that. Again, pension, profit sharing, and retirement plan contributions to the extent that they are discretionary. Depreciation, so that it reflects straight line GAAP depreciation over time and negates the effect of accelerated tax depreciation methods. I mentioned, and some of those examples are there for the non-recurring expenses. Rent and other related party charges. Often the building is not owned by the firm, but it's owned by the same owners or a subset of the ownership group. And the rent being charged to the firm may be based more on tax motivation for those owners of the building, cash flow. It may not represent arm's length rent, so we would need to do an adjustment there. And then non-operating items like the gains on fixed assets, investment gains and losses. And again, we would tax affect the earnings stream. I already talked about the effective tax rate. And one other quick thing, for anyone that is sending in questions and chatting, it's not looking like I'm going to be able to get to them now, but we are capturing all of them. And I will certainly reach back out this week to answer any questions that came in. So the economic benefits stream, typically we use historic earnings, adjusted as we just discussed for those abnormal, non-recurring or discretionary items. The look back period that we utilize is generally 5 years because it tends to capture a complete business cycle. If we used less, imagine the value of your firm during COVID, we wouldn't have had enough time to capture what the business looked like before or after to kind of get a flavor. But the 5-year period works well. And for some of the ESOP valuations that I have worked on in my tenure here, we have gone out further just to take a look and see, if we looked at 10 years, how would that change the value that we would come up with? And it honestly doesn't. So the 5 years really is a good period to look at. Just very quickly on the weighting convention. Here we have two firms that have the same total earnings over the last 5 years, and their average is $20,000 a year. However, the two firms have very different trends going on, so I would argue that we wouldn't want to use that average where a trend is indicated. So a simple average in those cases wouldn't really make sense. Instead, what we would want to do is do a weighting of the years with the highest weight factor on the most recent year. That will pick up the trend. So now when we run the math, firm A that was growing has a weighted average of 25.7, while the firm that was in decline has weighted average earnings of 14.3. So the second piece of the income approach is the discount rate. Think of the discount or capitalization rate as the rate of return that's required to attract an investor to making that investment. So the riskier the investment, the higher the rate of return that investor is going to want to see. If we're doing a discounted future earnings or discounted future cash flow method, then what we would be doing is looking at a series of future economic benefits, again, cash or earnings, and we convert that to present value by dividing by a discount rate. The capitalization of earnings is used where we're using a historic average. So we have a single number, and there we're dividing by the capitalization rate. The difference between the two rates is just the long-term sustainable growth rate. So once you calculate your discount rate, you would then reduce it by the long-term growth rate. And that's not the rate that you project over the next 5 years. That's into perpetuity. So we tend to use 3 to 4%. That's what the industry has done historically. It's what the industry journals indicate is appropriate. So we would calculate your discount rate, reduce it by that 3%, let's say long-term growth rate, and that would give us your cap rate. In terms of developing the discount rate, there are a handful of methods. The build-up method is the most common for us to utilize. You've probably heard of WACC, or weighted average cost of capital. Sometimes that's appropriate. But we're going to talk about the build-up method very quickly here. And it's basically builds that discount or capitalization rate by starting with a risk-free investment and the rate that would be appropriate, and then increasing that for additional risks that are required for an investment in a closely held stock. So this is a little small, but essentially we look to what a 20-year treasury bond would trade at. And there are no 20-year treasury bonds, but Kroll's cost of capital, it's a resource that we use for business valuation, has kind of a normalized rate that equates to what a 20-year bond would earn, and that's 3.5%. And we use that normalized rate so that we're not being affected by some of the interest rate changes that we've been seeing happen. Because over time, one would think that those ups and downs would normalize, so therefore the 3.5%. To that, we have to add an equity risk premium, because a buyer into your firm is not buying a risk-free treasury bond, they're buying a stock. So Kroll looks at the difference between publicly traded stocks, the rate of return they get, think S&P 500, over and above that risk-free rate, and that's an additional 5.5%, which means that about a 9% rate of return is what you're going to see for larger publicly traded companies. To that, we add a size premium, though, because you're not an S&P 500 firm. You're much smaller, and by virtue of that, riskier. And that's another 11% that gets added. So we're at about a 20% rate now. We then look to an industry risk premium, which is the difference between what the overall market is getting as a rate of return versus a particular industry. And there's a little bit of additional risk. It's hung right around this 1% mark, 1.23%. So that would get added as well. And then the final component is a subjective risk premium. And that is essentially taking into account maybe even a little bit more of a size premium, but it's also looking at your financial health. It's looking at management strength, diversification of services, the geography of the firm. Do you have a heavy concentration of clients? 50% of your earnings is coming from one or two clients. And that brings us to the discount rate when we add all those together, which is about 28%. As I mentioned, we subtract the 3% long-term sustainable growth rate, which gives us a capitalization rate of 25%. If you recall, I said that we take the benefit stream and divide it by the discount or capitalization rate. Conversely, the inverse of that is the multiplier. So a 25% cap rate is a 4 multiplier. Just as an aside, for the AE industry, typically when we're talking about earnings for internal ownership transition, that multiplier is between a 1 and a 5. But I would let you know that 2.5 to 4 is about what I generally see. And a lot of our firms are 3.5, right in that area. That is not the multiplier that we're seeing for mergers and acquisitions, but that's a whole nother show. So feel free to sign up for our half-day valuation seminar. I talked about that. The pros of the income approach, it considers that for future earnings potential. And it measures value in terms of a benefit stream, which is what the buyers care about. The cons, it can be hard to establish projections. Again, that's why we often lean more heavily onto the historic earnings. And there is a need for subjective input on factors like the discount rate, and even to a little bit of extent on what adjustments should be made to the earnings stream. Again, this is the reverse of what I showed you before. We have two firms with the same after-tax earnings, but their book value is drastically different. So are both firms worth the same? I'm hoping that you are seeing where this is going, that neither one standing alone is going to get us there. Very quickly on the market approach, I mentioned that the market approach looks to either publicly traded companies and derives multipliers based on earnings, cash flow, EBITDA, revenue, and book value. There are also comparable transactions that we can get the data from, and those are generally private companies, and they tend to be much more comparable than publicly traded companies. There really aren't any publicly traded, definitely architecture firms. And engineering firms are not pure engineering. They generally have construction, development, land management. They have all kinds of different things in that one company. They're a conglomerate. Whereas for the comparable transaction method, we get a little bit better comparability, and we can, again, derive multiples to apply to those metrics. And then finally, there are industry rules of thumb. This just illustrates, and I haven't updated this recently, so probably some of them have merged or gone out of business. But basically, it's just showing that we can get these median multipliers for what the enterprise value would be as a multiple of revenue, EBITDA, equity, different metrics. The pros, it's easy to calculate and understand because you're just taking it's easy for you. It's not as easy for us to do the analysis and get these multiples. But it is easy to understand. It does consider external factors that are driving the market. But as I mentioned, comparability is difficult to achieve. And rules of thumb are just that. They're very broad, and they don't consider the specifics of your firm. So this is from Zweig Group, and it's showing how we would calculate value based on multiples of book value, net revenue, EBITDA, number of employees even. And as you can see, we've got, I think, a low of 2.5 million. And where's our high? 9.2 million. So the range is ridiculous. What I generally do is put a lot of weight on that EBITDA multiplier when I use the rules of thumb. We do look at it as a sanity check, but it's not how we're going to value your firm. So how do we value a firm? Basically, we utilize a hybrid approach where we're looking at the fair market value of the firm's net assets, so it's adjusted book value, as to establish the minimum. But we also need to pick up the goodwill, that earnings potential that picks up on the firm's reputation, its systems in place, all of those intangible assets. That's the goodwill portion. So we have, for the last 40 years, referred to this as the AE formula approach. If you pick up a valuation textbook, nowhere will you find AE formula approach. But after doing it for over 40 years, it's something that we have kind of coined. And again, total firm value is going to be adjusted book value plus goodwill value. I'm going to skip some of this because I've already talked about the adjustments. This is what the balance sheet would look like when we do some of these adjustments. So in the first column, we have the historic book value on the accrual basis right from your financial statements. And then we're going to make adjustments to that to bring it to adjusted book value over on the right. So you can see some of these adjustments like increasing the allowance for doubtful accounts. Maybe there's one or two receivables in there that don't have a good likelihood of being collected. So we would want to increase that reserve. Bringing on the unbilled work in process. And again, that can be a significant asset for the firm. An adjustment to accumulated depreciation to reverse the impact of tax bias in the depreciation method being used and bring your fixed assets closer to their current fair market value. We are adding $20,000 for libraries, maps, and drawings. Again, that's your technical resource library. In this case, the investment in the joint venture must have been a winner because we're bringing it up to a value of $187,500 from the original contribution of $5,000. Loans receivable from stockholders. Sometimes those aren't going to be repaid, and if that's the case, we would negate that. On the liability side, one of the most common would be in your accrued liabilities to potentially pick up unpaid PTO is a big one. And then, as I mentioned before, we're going to look at your accounts receivable, your unbilled work in process, and your prepaids, less your accounts payable, your outside consultants payable, and your accrued liabilities. And we're going to tax affect that at the appropriate rate and bring on a deferred income tax liability so that a buyer of the firm is paying for the net after tax so that it's worth the same outside to them buying as it is to you on the inside. The income statement, again, we would put together 5 years and it would be in this AE format. And we would show these percentages as a percentage of net revenue. Again, it's helpful to be able to see how the firm is measuring up compared to itself. It helps identify adjustments that might be necessary and also how it's comparing to other firms in the industry. We would take the pre-tax net income or loss from your historic financial statements, pre-tax because we'll tax affect it at the end. And again, there's going to be adjustments here. You've got some add backs for that accelerated depreciation. You've got some add backs for officers' compensation. Perhaps the owner or owners of the firm were taking a little bit above industry norm. That really is a discretionary use of earnings, so we would add that back. Profit sharing, same thing. And then computer software. So there may have been computer software that your accountant didn't capitalize and put on your balance sheet, and it's sitting in an expense account. We would want to, for valuation purposes, add that back and then take depreciation pro rata over the useful life of the assets. Whoops. And then, as you can see at the bottom, we're going to tax affect that. That's going to give us our after-tax adjusted net income. Here we're going to use a weighted average, which tells us that the average net earnings of the firm are about $219,000, which if you look across those 5 years, certainly there is a trend. 20x8 was a little bit of a blip, but in general, the firm is trending up. And then the earnings multiplier that we came to before of 4 gives us a practice value of 875. I'm going to go back one thing. On the liabilities and equity section, I didn't point out that we start with 1.667 in stockholders' equity, and the sum of all of our valuation adjustments is a small decrease, primarily because of the deferred income taxes. Now it's worth 1.651 million, and our goodwill is worth 875. Which brings us to adjusted book value plus goodwill, so a total value of $2,527,000. And I think I made it. Look at that. Again, you'll receive a link to the PowerPoint. You'll receive the slides, and if you asked questions, again, I will be glad to follow up with you later this week. I thank you for your time and have a good rest of your day. Thank you.